I'm Alicia, and I am the host, I suppose, of these webinars. I'm also the CEO of Seraf and by extension, the Seraf Compass. And our main mandate is to help investors from a software standpoint track their investments in early stage companies or otherwise. And so that's where we come from. But the Seraf Compass is our educational platform, and that is where we deliver content like this. So this webinar here is around London theater, which is not your traditional asset class, I think, but is one that I find very interesting. And I've got two lovely people here with us. We've got Huw and we've got Josh. Do you go by Joshua or Josh?
Josh is fine.
Just Josh. Okay, great. So we've got Josh and Huw. And full disclosure, Huw is an MBA classmate of mine. I think he's just the greatest of guys, but he's here to talk to us about what you guys got going on. Just a quick background on these two. You guys have been in theater for over, a decade each? Something like that, at least from your bios? Yeah, so quite some time. So a lot of experience there in theater production. And now you guys are spinning up a new firm, which I think will give you space to talk about. But I think let's go ahead and have you guys give your backgrounds. Maybe Josh, I'll have you go first because I know you less well. So yeah, why don't you give us your background quick, your bio, and then we'll move into questions.
Hello, everybody. Nice to meet you. And thank you very much, Alicia, for that introduction. It's great to be here. I'm a commercial theatre producer, a London-based, UK-based commercial theatre producer by trade. And I've spent the last 15 years working in the commercial sector in the UK and worldwide, stretching as far as Moscow and Australia, and also in the States and elsewhere in North America too. So yeah, I mean, my background is predominantly from a production perspective. I have been at the sort of front and center from a production and general management perspective, which is the sort of the day-to-day commercial operations of theatrical production in the UK, where we typically raise capital from investors with the aim of providing them with a nice, lovely return at the end of the endeavour, with the joy of some great theatre in the meantime. And so I guess uniquely what I have done maybe that's different to other commercial theatre producers of a similar ilk of mine is that I've worked across quite a variety of scales. That's shows that have gone big title shows, big above the title actors that go straight into the West End, and those shows that have toured also across the UK in what we call the number one circuit, which is the kind of the best venues performing a week each across the UK and across the world, all the way down to smaller kind of talent development areas, predominantly the Edinburgh Fringe Festival, which you may or may not be familiar with, but is really making a resurgence as a hotbed of talent at the moment, of where really exciting projects are finding their feet, finding their audience. And then what we tend to do is we either are starting those projects there ourselves and developing them after that, or we're searching and finding out great projects and then bringing all of our additional expertise and growth sort of strategy to those projects and taking them to that next commercial stage.
Amazing. Thank you. And Huw, please go. I'm going to come right back to you though, Josh, because I have a question about the segmentation of the market, but you go ahead quick.
I have no idea I'm going to follow that. That was amazing. So my name is Huw. Yes, full disclosure, I am a classmate of Alicia's. We worked together quite a lot and it was a lot of fun. I'd also like to add that the term angel investor was originally coined for theatrical investment. I couldn't tell you when, but it was a very long time ago. But that's the genesis of that term. So my sort of career has been quite varied. I've worked within the sort of media and entertainment and sort of strategy sector for most of my career. Josh and I have worked together for a number of years now. My focus has been a lot more on the sort of financial sense because, as you can tell from what he just said, he has all the other technical bases completely covered. And we've been working together for a number of years on, essentially, my role has been much more financially strategic, I would say, in the sense of like bringing investors in and taking them on the journey, because it's a lifelong thing. And we've come up with a sort of a new product now with a sort of style of theatrical investment fund, which we can't actually use that term, but that is essentially the way that we're structuring it. And that's what we're pursuing now and why we're here on this call with you today.
Amazing. Thank you. And do you want to talk about the gist?
No, I do. Oh, no, I can't talk about it. Gist is another project that I'm working on, which is me talking about business straight to camera, which is a lot of fun, takes up a lot of time as well.
Yeah, I understand, but you've gotten great reception and hundreds of thousands of views, millions of views actually at this point. So in the span of months, you're doing great. So anyway, like I said, I wanted to go back to Josh here to talk about segmentation of theater and how you were talking about the circuits there. I think give us like a base level knowledge on what I think just starting from the ground up. So assuming that I know nothing about theater, which I don't, I went to see How to Kill a Mockingjay, maybe like in London when I was there. A Mockingbird, yes, not a Mockingjay. It's the Hunger Games. So yeah, so give us like base knowledge on what theater looks like, the different segments of that, and then the investing in it, how one might look at that.
Yeah, so we're talking obviously predominantly about the UK, and the UK is, I would say, less cleanly split than you have in the States, especially in New York. You very quite neatly have Broadway, off Broadway, and off Broadway. That's quite nice and neat, and there's a very clear kind of touring sector in the US, and that works in a very different way than it does in the UK, for a variety of other reasons that I won't start now because I can feel myself going down that little channel. But we're back in the UK, so the West End. So I would argue that there are three or four main sectors really. So there's the West End, which is the centre of London, and there are a number of theatres that are classed by the Society of London Theatre that are West End theatres, and those theatres are the most prestigious theatres in the UK, and those shows are big commercial vehicles, plays and musicals, which are the top of the tree in terms of the business in the UK. There is a touring sector that I mentioned, which is what we call the number one touring sector, which again is big regional, outside of London, regional theatres in and throughout the UK. And those are in the main anywhere between about 1,000 and 2,000 seats. That's roughly where that sits. Elsewhere in London, there is a less defined, but a kind of a fringe theatres in London that kind of go anywhere from about 100 seats up to now about 400 seats. And so those can be, that operates again also in commercial fashion, where people raise smaller amounts of capital to put on projects which that may be the first stage of their life. That's a really great way to conservatively test and explore the product and the project. Basically, when you're in the West End and when you're going on those number one tours, you're pretty certain about the commerciality of what you're putting out there. They're less areas to test the commercial viability of the work, really. And then beyond that, the Fringe, really, Edinburgh Fringe Festival, which is the largest theatre festival in the world, has approximately 4,000 shows that happen in Edinburgh every year. The population of Edinburgh doubles during the month, which is the month of August in which the festival takes place. And it is, where there's a great tradition in the UK where all of our best comedians basically all started up in Edinburgh, and everyone who's a household name got their break there. And then more latterly, what we've seen is huge commercial shows that have crossed over globally as well and have come over to Broadway. Shows like The Play That Goes Wrong, Six, the musical, are huge big hits, all got their break at the Edinburgh Fringe Festival. And what the Edinburgh Fringe Festival does basically is turn any available space in Edinburgh into a theatre for that month. I have seen shows literally in corridors with chairs in, and you get to see these most fabulous productions which then go on to have these most amazing lives afterwards. Phoebe Waller-Bridge, who wrote Fleabag and is writing the last Bond movie or the current Bond movie, she had her huge break up in Edinburgh. And so there has been a renewed interest in that being a real great place to start work. And actually, I think what people are finding now is that is a great pipeline for the work into TV too, and a bit of a crossover there, because in that same month of Edinburgh, the television festival also happens. So the other big hit, I should have mentioned, that started in Edinburgh more recently is Baby Reindeer off Netflix. So that was a one-person play that started up there and then was due to transfer to the West End, but didn't because of COVID, and then became that huge big hit on Netflix. So yes, I would say they're the sort of the four main areas you're likely to encounter as an investor in the first instance.
Okay, thank you. That's very helpful. And moving to the more commercial side of it, how can you talk us through like how productions are financed? I think to start, how productions are financed, how the cash flows work, because I think it's very distinct from other what I'll call asset classes, right? So you have real estate, you have private equity, you have venture capital, angel investing. These are all distinct asset classes, all somewhat, VC is not that niche anymore, private equity not that niche. But talk to us about theater and how the cash component, how the investment component works, and how those things are distinct from these other asset classes. And Huw or Josh, it's up to you.
I mean, I can start. I think normally in the sort of very much the commercial sector, they are privately funded, usually because of the scale of the ticket price, which is obviously it's a sliding scale depending on how much it costs to put the show on. But normally they sit around, it can be anywhere between 5 and 25,000 in the UK. Josh, feel free to jump in if I'm saying anything out of turn here. But so normally what often happens is there's producers will have a pool of their angel investors, and it operates in what I think in the broad investment term would say the sort of friends and family model because of the scale of investment. That's the sort of traditional thing. I think what you're normally essentially financing in that is that you're essentially paying for to build the show from the ground up to get it to the opening night, and then every week for the run, which is traditionally roughly around 12 to 16 weeks from the off, depending on the season. You've got the weekly running costs of the show that need to be financed by the ticket sales of the show, and every week cumulatively, you essentially want to pay. It needs to wash its face every week, and you need to earn enough money for it to pay for itself that week, and then also an additional surplus of that to pay back the initial investment. There's one thing to, I think, mention at this point, and like I said, Josh, jump in if I've missed anything, is that in the UK we have a very generous scheme run by the government, which is called Theatre Tax Relief, TTR for short. And we essentially, what that does, it's varies slightly from touring to sitting shows, but broadly speaking, the government will essentially reimburse the production with just over a third of the initial upfront cost of putting on a show. So if you look at this as a scale of how much is actually at risk, there are certain things that aren't applicable to theatre tax relief, but broadly speaking, there is a big government incentive to invest. And of course, what that essentially does is it brings down the break-even point for the show to have broken even. Does that answer your question? Is that
it does? No, it doesn't. That tax component is helpful and interesting because I think the UK has done a really good job of putting in place tax incentives for private market investing. So they have the SEIS or BIS, I don't know which one, or both for startups. And so that's interesting that they're incentivizing this kind of investment.
There's another good point to make, I think, on theatrical investment. If you look at it by comparison to other investment vehicles, for instance, is that your traditional VC private equity firm fund, if you were to put money into that, they have an invest, divest pipeline, timeline, whatever, of 8 to 10 years, depending on where you are. Theatre, the beauty of theatre is because your invest divest period is dictated by how long the show will run and what its earning period is. So let's say it runs for 16 weeks. But broadly speaking, it's not uncommon for you to make your initial investment and then get the money back that you've either made or whatever is left at about 18 months later, broadly speaking. So that's also a very exciting kind of prospect, is that actually your money isn't tied up for very long, by merit of the fact that the show will run for that period and then it will close and then the money will come back. So it's dictated by the market in that way.
And those timelines they're obviously different by tier of show, but can you give us an idea of what the highest tier, so if you're talking West End type shows versus something, I imagine, I don't know if people are investing in
there is
Festival, but
there is the period that Hugh's talking about. Once what we call the production phase which is basically everything that happens in the building of the show and the rehearsing of the show and making the sets and the costumes, all of that period up until the first performance in front of an audience, that's the production period. So once that period is completed, that effectively within the tax cycle that's in for the company that the production is operating through, that is then complete and the theatrical tax relief can be claimed. So it is effectively always an 18-month-ish, sometimes depending on HMRC themselves and their speed or delay. That's normally the period that you're getting that initial return back in terms of tax relief. There is then an ongoing, because tax relief can then be claimed predominantly on royalties, which is paid to the writers and the creators of shows for the ongoing exploitation of their work while it runs. That's also claimable for theatre tax relief. So there is, in fact, a continuing claim for tax relief if, for example, the production is a long runner. Now, that happens less now due to availability of theatres for a variety of reasons. So again, on the smaller scale, it's likely that you're doing something for a fixed period of time, whether that's a tour, you would know how many weeks it's going out on the road for. Again, a West End play, for example, 9 times out of 10, if a star is attached, a big television or film star, they're doing it for a fixed period of time. Musicals are slightly different, where you're mounting a musical, where it's a branded musical, if it's based on a movie or based on a book, those can be on open-ended runs with the West End Theatre. And Huw says if that's doing the business, then that can continue for an extended period of time. That's the hope. So that's what we wish for. But I think what the point that Huw makes there, I think that at the moment we're finding a lot of American interest in the British theatre market. And that's because, as Hugh says, theatre tax relief covers a good portion of the capital, so completely de-risks a portion of the capital at risk. And the second most important is the costs in New York and the costs in America for theatrical production has gone through the roof to the highest level it's ever been, and it is quite substantial. Even post-COVID, and the costs in the UK have gone up, but nowhere near to the extent to which they have in New York. So again, in the UK, what we're finding actually now is that American teams and American creatives and producers are coming here to start projects because the cost of starting something or developing it here is considerably less than doing it in the States. Plus, on top of that, you add the theatre tax relief, it's even more de-risked then to that point. So I think that's a big incentive for investing in British theatre production. It's because, again, the costs are considerably lower.
It's something like nearly five, I think it's something like it's 5 times cheaper in the UK or something like that, isn't it, Josh? Somewhere around that figure than it is on Broadway by comparison.
What portion of the cost is cheaper? Is this labor? Is this materials? Is like what is making that differential so big?
I think it's partly labour and it's partly union laws on Broadway and in New York, in union houses across the states, that the cost of doing that, but also what we call physical production, so the sets and the costumes and the wigs and all of those sorts of things are also considerably more. In 2023, we were looking at doing a play on Broadway and we were doing a play in the West End at exactly the same time. The capitalisation at that time for the play on Broadway was $5.5 million, and for a similar play in the UK, the capitalisation was £750,000. So again, quite a difference in terms of they were very similar physical shows in terms of their size. So there's quite a disparity in the costs.
Okay, that's interesting to me because that's something I genuinely did not know. And anyone in the audience can drop questions into the Q&A. I'm going to take this one just because we're on topic. Alan, can you tell us whether the payback model in the West End is the same as the payback model for Broadway?
The difference between Broadway and the UK kind of predominantly is the kind of the issue of shares in relation to the operating business. That's not the case in the UK. So that there is a slight sort of legal and technical difference in the capital committed. When they say payback, do they mean portions of what the investor earns versus?
I think so. Your waterfall model would be my guess.
So in America, the split between kind of in the profit position between the investor and the producer in the US is 50-50. The standard model in the UK is slightly favourable. Again, it's 60 to the investor, 40 to the producer. So there is a 10% swing in favour of the investor in the UK.
Okay.
Hugh, am I missing anything there, Hugh?
No, I think that's it. And I think also what you said about the shares, I think it's a lot less complicated in the UK as well when it comes to the actual investment model itself. The split seems to be a lot easier. And of course, it's a negotiable thing depending on the scale of your investment, I think, often as well in your relationship with the producer.
Yeah, I think that's a good point to mention, Hugh. Again, the 60-40 terms would be standard terms for committing a unit or a number of units into what we set as the units in the show. But again, what we do is often tier those units up. So, for example, at sort of 10% of the entire capitalisation, that normally attributes a movement on that percentage split. And then as you're going up beyond that 10%, again, billing above the title, below the title, those sorts of inclusion of your name and your biography in the programme and those sorts of things as an associate or as an assistant producer position, those become tiered in that sort of increasing capital.
Okay, and just follow-up question from Alan. So and we didn't talk about this sort of capital stacking structure here, so I want to dive into that a little bit. So if you have a production, and it would be helpful, I think, to use actual, obviously made up numbers, but so say you have $1 million production, all of that is from investors. So there's no capital raise outside of, you're not using debt, you're not using anything, like all of that is cash capital raise. So then from there, how does that capital get split via payback? So that's what you're just talking about, but I think it'd be helpful to start from the beginning and then go there because we're getting deep in questions and I want to make sure we have the structure to understand.
Sure. So the normal kind of structure is obviously the theatre will take a gross percentage, a gross figure from the box office. Then there is obviously there's a value added tax that comes off that, and credit card fees and certain things like that. And then there's normally a split between the venue and the producer, which is normally, and Josh, please feel free to get involved here. Obviously, that changes over a certain scale, but normally it can be a 20-80 split or a 25-75 split. So the producer then gets, this is the whole waterfall, producer gets 75, and then from from the profit from that is split with your deal with the producer. So the producer will keep 40% of said profit, and then the investor will get 60. And of course, as Josh said, tiers up depending on your deal.
Yeah, so you would recoup the entirety of the £1 million or $1 million capitalization, and then for every pound profit, it would be obviously split as per the number of as split the per the million investment in those proportions that people are invested in that million, and then as Huw says, that would be split between the producer and the investor 60-40 at the very minimum.
Okay. And so the way we can't apply the terms, but you've got the 1x liquidation preference, and then you've got your carry, I don't want to call carry for the angel investors and the VC investors. Okay. Thank you. That's helpful for just clearing that up. I'm going to come back to questions because you guys are a curious bunch. We'll leave a lot of time for that at the end. So my next question, it would be more of an opinion question. Where do you guys think theater could fit in terms of a larger portfolio? So as people think about how to diversify their private market investment portfolios, how would they think about theater relative to these other ones that are available?
If I may, I might jump in on this. I think the thing about theatre that's really, if you look at it from a purely sort of investment standpoint, is that it's almost completely, from a diversification standpoint as well, it's almost entirely uncorrelated. And not only just uncorrelated in the sense of with other industries, but they're almost every product is uncorrelated. Because you have two musicals, cost the same, at the same thing, will they both perform at the same rate? Of course, that, as we know, is very much unknown. And obviously there's an element of trust with the producer and their rationale behind it. But I think that actually it's a very good way to diversify portfolio. Of course, there are ancillary benefits that come with it as well, because there's an element of it's tangible. There's a benefit of it's experiential. That's the word I was thinking of, where actually there are additional benefits from that, where when it runs in a physical capacity, there's the opening night, but there's, of course, as Josh said, there's the sense of billing. We find that occasionally people actually like to use it. They will invest, but they use it as their own sort of corporate hospitality. It's part of their own sort of portfolio in the way of bringing on their own clients and things like that. So there's all those sorts of benefits that come with it. So I think that is one of what we're finding is one of the main sort of pulls, but really it's correlation with either other industries or even internally within itself and other artistic kind of endeavors too. That's the reason. That's the biggest thing. And I think also the divest period being very short by comparison to other things is it's a cash in, cash out business, basically. It is pretty liquid.
Okay.
Over time.
And how big is the opportunity to invest? I guess that's not a question that I prepped you guys for, but is this 100 plays a year that would be of worth to invest in? Is it 1,000? How big is the opportunity for investment?
There are only so many theatres, and
exactly.
there are only so many weeks in the year in that. I think, again, what we're talking about here in terms of the UK, the lower costs in terms of Broadway, I think you can get more bang for your buck in the UK. That same unit level either is lower, but if you kept it at the same, say, as a Broadway unit, you would be getting a substantial amount for your money, a good portion of that project. So I think that's one of the key things in the UK. I would say that Huw and I have two types of investors really who work with us, and those, one is a fixed investor, and one I would say is a sort of comes and goes depending on what we're doing. We have people who invest with us because they trust us, they like us, they back what we're doing. And so those people will come in because they want to come along for that long-term ride with us. And we like those people very much. And then what we tend to find is people who come in on a project specific basis. So that is something they love. It's a show they love. It's a book they love. It's an actor they like. It's at the right time for them. We have a sort of a mix between our core investors who really understand it, really, like Huw says, enjoy the ancillary benefits and the long-term involvement with the kind of the variety that we're able to offer. And then there are people who come because they like whatever it is that we're doing at that particular time, and there's project specific. What we tend to say to people is that we always find with people, if you're not involved in the business like we are, and making that decision is very difficult. So again, we say to people, come on a smaller basis with us over a longer period of time, over multiple projects, to experience that over a longer period of time. We find people get more out of it that way. And also there's a kind of a de-risking in that exposure across multiple projects instead of all in on one specific project. I'm right in saying that, Huw?
Yeah, that's literally it. The portfolio diversification, small amounts over a long period. And I think also what's worth adding in there is I get approached quite a lot by people from our MBA, actually, Alicia, saying, oh, this plays on, Bryan Cranston's on in the Help Into Doing All My Sons. I'd love to invest in that, because obviously you can't get a ticket. And the answer is, they're like, how do I do that? And so the answer is, you in this, guys, if you're not on the journey, you can't, because those are shows that are on paper before any of us know that they exist. We'll probably be doing fantastic business because of Bryan Cranston from Breaking Bad is in it. And so the best way to get into the sort of arena is to have a relationship and to do it. But as Josh says, and I think it's very prudent fiscally, is you do it small amounts across the time. You learn as well as a sort of investor, because as much as you have to make the decision as to what you invest and what you pick. As Josh says, we've had people who will invest even though when the unit economics are fantastic, of course, with all of our projects, but they will invest on something that they like. But there is always an element of choice. And that's the sort of most important thing, is actually educating yourself. I would say if you ever have any questions on a show, what's to invest in, just call us. We'll steer you the right way.
Thank you. And I think that moves into my next kind of section of questions on risks that are associated with the asset class, and then things that people should consider from a diligence perspective. So let's start with the risk first. Outside of you could do normal and abnormal things that are specific to the asset, but what are risks that, if you're investing in a theater production, what should you look out for?
I think the first thing is, of course, that you'll be presented with an investment prospectus by the producer, which will detail a lot of the sort of creative things, which have got who's in it, the reason for putting it on. They'll have a sort of rough business rationale as to why this is the right time to put it on, and then they'll obviously have a breakdown essentially of the figures and what rate that they have to, what gross percentage of the box office they have to sell to recoup for you to get your money back. I think the thing that is always there is always a risk in that. Theatre is a very capital intensive business, in that, like a lot of other businesses, you can sort of soft launch and test the market. But with theatre, that doesn't really apply. You either have to know, you know what you're talking about and you go out there, but there is always a sense of you're banking on people having a desire for the product that you're making and then voting with their feet, essentially. So there is always a risk that the steer might not necessarily be right. And it does happen. It has happened to the most successful and the richest theatre producers in the world. They've all had projects that just didn't work for some reason or another. I'm not quite sure on the other kind of, Josh, I'm sure you probably got more detail on this than me, other kind of different reasons to look out for, non-traditional ones that I might have missed.
Yes, you said before about people phoning up saying, how do I invest in Bryan Cranston in the West End? That's a pretty good cert. I'd say you're pretty likely to make some nice money out of that. And again, 9 times out of 10, I would say commercial producers are putting the project on and it has to go through a level of due diligence just to exist. For example, if a West End theatre is booking the show, that's quite a high bar of due diligence for it to pass, for it to go on in a West End theatre, especially at the moment. West End theatres are in high demand. Similarly, again, on a #1 tour in the UK at the moment, there is a ratification process that happens where if you and I are touring a show to 25 venues, 25 other people have to go, we think this is going to do a great 8-show business in our town. And so already there is, at some of those projects, there is already a level of, well, enough people here think that this is a goer and this is how we're going to go. Obviously, things that strengthen that are well-known titles, films, books, those sorts of things. But having said that, what you tend to often find is that those things can exist for a period of time. The real great, big, massive hits are actually the shows that people have supported the producer or the creatives in something that maybe they've said to the investors, we've done X amount of shows. We'd love you to come and support us on this slightly riskier endeavor. But actually, that then builds its own brand, its own audience, its own longevity. A great example of that recently is Operation Mincemeat, which is playing at the Golden on Broadway at the moment. That show started in a tiny theatre in the UK. It was an 80-seat theatre called the New Diorama in London. It was picked up by John Thoday, who's a very well-known comedy promoter and producer, and it went on a couple of iterations in really small fringe theatres. And then they took a big leap and took it to the Fortune Theatre, which is a small theatre in the West End, 400-seater, and it was a colossal hit. And on paper, that would seem that they were managed to do a little bit of testing that along the way and building and bringing the audience with them in that kind of Edinburgh Fringe model that we talked about before, and then really going for it, which they did. And again, there was a lot of trepidation. Originally, I had heard they couldn't get a theatre on Broadway. They wouldn't give them one. And eventually John, a great producer, went for it. And now I think they're on their whatever it is, third, fourth, fifth extension on Broadway, and the original cast are about to leave, and they're recasting it because it's a British company with a fully American cast out there. Absolutely amazing in the economics of Broadway at the moment, and so I think that will run and run. But so again, just to give you an idea of the completely safe cert isn't always the way forward. Actually, backing a producer you trust or you've had a couple of smaller interactions with initially, those can be the really amazing, rewarding, exciting opportunities.
Yeah, Josh, how long did it, sorry to interrupt you, Lisa, how long did it take from the start of Operation Mincemeat to now to get it on Broadway? What was it? What was it, Johnny? 4 years?
Yeah, about that, I would say. Yeah,
Which actually, if you think about scalable from literally being in a corridor, which is basically where it was to start off with, to a big Broadway house. I mean, another one from British export is The Play That Goes Wrong, which Josh mentioned at the top of this conversation. That's now been off Broadway now for, what was it, 8 years, something like that?
Yeah, it's a long time, and so, it's just had its 10th anniversary in the West End.
Yeah, and yeah, so it's a journey.
Is there a component of, so each production, as something were to move up tiers, right? So up classes of size and such. If an investor invests at that original version, right? So I want to take a bet on this. I think it's really cool. It's going to be in a couple small theaters. I don't know, it's called IP associated with that. Does that transfer at all as that play moves up in rank?
That's dependent on the relationship with the producer again. So yeah, in some instances, if I don't know if they did this in Operation Mincemeat, but if we were producing Operation Mincemeat and we had picked it up in an 80-seater theatre and we said all our investors, we'd like you to come and support us in a small 200-seat theatre in London. There's not an enormous upside, but what we can offer you for getting involved in that early stage is preferential investment terms long term in the show, securing a percentage of the capital when we get to the West End stage. So there is all those sort of early stage preferential opportunities if you're supporting a project in those early stages. I don't know if they did that in Mincemeat, but we have done that recently with a show of ours.
Which is
where we've launched a sort of a brand that will have spin-off shows. So it has a core central show that we've done, and then it now has just done its first, and we've just secured 3 extra spin-off shows, and all of the initial investors in that first version have the opportunity, and it's their call. Do they want to come in for the same portion on those additional spin-off shows, basically?
Yeah, and often sometimes what happens is similar to preemption rights with startups, is that if you invest 25% of a show up in its first iteration, you're entitled as it grows, and if that will close, you then have one that's at a bigger theatre, as Josh said, with a double the capitalization. You're entitled to 25% of that at that level, and if you don't invest in it, normally you lose it, like with preemption. It's the same kind of thing.
Okay, thank you. That was just one I was curious about, like how that flows. So I think, do I have any other quick questions here before we move to Q&A? No, I don't think so. I think let's move to Q&A because we've got some good questions in here. I'm going to start, I think, from the top. We talked over splits. We talked over capital stack. What is the life cycle investor model for each phase of development and revenue? I think we've covered that in terms of timing. And then we've got waterfall. If it's a hit, what might be the cash on cash return? Yeah, that's, I suppose, a big question, right? So you have return profiles for every asset. What for theater, and I imagine it's a range. And so maybe
Yeah,
relative to outcome.
yeah. If you'd invested in Phantom of the Opera, what, 40, when did it come out? Just 40 years ago, more than that, you'd be doing fine. I think normally it's what ends up happening, and the way that I look at it is once the show's recouped and you've got your initial investment back, you're essentially just entitled to a cash flow for as long as it runs. That's the way that you have to look at it. Cash and cash flows, again, it's all predicated upon the cost of the weekly running cost. I think obviously it's the biggest thing once you've got your initial investment back, because if it can gross £500,000 a week, but it costs £300,000 a week to run, then you're only ever really going to be getting that. But again, if it's as Josh said, if it's a musical, they cost much more, broadly speaking, than plays, because obviously there's a big labour cost involved with that, but also they are open-ended, so they can run. They're built to run for a longer time because the upfront cost of creating them is a lot larger too. So I guess it is a sliding scale. And I think there are, like you said, there are some absolutely rocket musicals that have been around. I think Cameron Mackintosh said 10 years ago the initial investors of Seraf had been paid back something like 400 and nearly 480 times their initial investment over 40 years or something like that, something crazy. So it can go on for a long time. Josh and I were talking about this the other day. There's the longest running play in London is The Mousetrap, which is now in its 76th year, I think. And so you think about the initial investors, and their grandchildren would still be getting payments back on that initial investment because of the way that it works. So it's fascinating.
Thank you. So new, do investors come on a play-by-play? Yes. But maybe quickly, can you guys talk about the firm that you are coming together to launch? Because that seems to me like it's not a fund, right? That it's different than
Essentially, what we're structuring, and what Josh has really nicely highlighted earlier, is that often we put a lot of shows on. A lot of people put shows on, and to understand the economics and the way it works, of course, having an in-depth understanding of theatre is very advantageous. And of course, Josh and I have got that over the time that we've been working in the industry. And I think actually, rather than picking an individual show per se to invest in, what we've come up with is a model where essentially we gain investment, and then within that we will distribute that across shows that we have access to because of our connections within the industry, but then also we can make a call because of our sort of expertise and the time that we've been working within the theatre industry of what might work, why it might not. And we also obviously have quite good insights into what is happening within the industry right now and how that fits within it and all of those sorts of things. So essentially we're structuring an investment model in a vehicle that would basically operate like a production company, but would just invest in other shows rather than create anything itself. And that is really to take the onus off the investor having to choose specifically which one might work or not, and essentially outsource that to us. But they can still participate in the upside of obviously potential returns, but then also the benefits of having access to those sort of things that they may not as an individual. And so, and of course, because we've got the way that, as we talked about funds before in VC, VC and PE work across an 8 to 10 year period, but we can run this at a 3-year period because of the beauty of the invest-divest period of theatre and the cycles in which we can do. So that's the sort of the product that we've come up with and that we're working on as we speak.
Wonderful, thank you.
Predominantly invest only really working within the UK as well. That's the main takeaway here.
And I'll send a follow-up, and I'll probably ask you guys for an example prospectus for like just something historical, right? Because I'm interested to see what that looks like. I think other people would too. So we'll get there. Next question up here. What is the feeder system for West End? Is it similar to Broadway and off-Broadway regional theaters? And do the 100 to 400 seat theaters play the role of the feeders to the bigger theater system?
Yeah, I would say yes. I think that often what happens is there is a sense of testing. It all depends often is that every show is obviously unique, and some of them do have a limit as to where they can go. Not every show can they can do the Operation Mincemeat journey and be scaled up to a way where they can fit within that and be commercially viable. So there is obviously a feeder system within the smaller theatres in London around the UK. And Josh and I have worked that model with the show that we were talking about earlier, where we started at a smaller scale, establish the brand, but also prove its worth with essentially the lowest sort of risk profile in order to do that. That it is possible to raise a lot of money and put it straight into a West End, if you can get a West End theatre. But of course, it's a very high risk profile for something that actually over time, if you just add time and you spend 2 to 3 years establishing it, bringing it in actually becomes one, not only de-risked, but also becomes, you get to refine it as you go, which is what Josh and I have been doing over the last couple of years with the show we were talking about earlier. So I think, Josh, please jump in if I've missed anything on that and the way that the theatre sort of fill into the West End. But that's broadly speaking how it operates.
Yeah, no, I see it. Josh is here in the Q&A answering questions.
Sorry.
There's a guy who, Alan, invested in Operation Mincemeat, and so he's got differing perspectives on the model here. So I'll let you do your thing. Let's go continue on questions. What is the typical risk reward? For example, it takes 10 shows to stand a chance of making a return on one. So like you have your startup model where you have to invest in 100 and not 100 exactly, but at what point does this become viable? How many should you spread out upon?
Within our sort of the model that we've built within this investment product that we talked about is that we would essentially, over 3 years, we'd invest in 15 shows. They would be across 3 sort of tranches, I would say, of theatre, which is one is touring dramas, touring musicals, and then limited run West End dramas rather than musicals. And the reason we do that is in exactly how most sort of investment funds operate, which is essentially you de-risk by having lots of different variations across the thing, but also things that can operate at the same time. Because obviously the beauty of the way that this model works is not building on like a business growing over a certain period of time, which has all those things. You're operating on the seasonality of way that theatre works. Broadly speaking, it's essentially from September through to December, and then January through to end of April. That is the theatre season in the UK. In the summer, we obviously have the Edinburgh Fringe Festival, as Josh mentioned, but it's the theatre scene, unless they are very well-established musicals, sort of quietens down because everyone wants to be out in the sunshine. Although unless you're in England, that obviously isn't happening anyway. So that's how it works. And so by us having that sort of portfolio of different theatrical invest products within, that's what we're trying to do. And of course, there will be variations. The beauty of theatre tax relief, coming full circle here, is that we're raising a fund that's roughly around the £3 million mark. Only a third of that capital is ever really at risk due to the fact that the theatre tax relief is locked in now for the next 3 years by HMRC. So that's broadly. We can go into more detail, of course, on that. I can follow up afterwards as well.
Okay, great. Yeah, no, I will send the recording follow-up along with any materials that you guys want to send, just as a benefit of coming to do this and educate us on this topic. Any other last questions? I think I caught most of them. Any other last questions from the audience before we call it a day and move about with much more dry topics? I'm sure everybody's got to go. I've got to work on dry things today, so this is like the highlight. I'll give another just minute or so in case there's other questions.
It's great to see all these questions. It's wonderful.
Yeah, I find that our audience here, we try to go pretty detailed because people are interested in detail. Like it's just, we rarely do anything that's like higher level. A lot of it's logistical. A lot of it's, how to do with this exact thing, which is why you get all these questions. So I think we'll call it there. And thank you all for joining. And Huw and Josh, thank you so much for coming to share your knowledge on the topic, because I think it's interesting at the very least to learn about and be a little bit more educated than we all were yesterday, at least that I was yesterday or this morning. Thank you. I'll send a follow-up, and everyone have a great day.